Good morning, everyone. Welcome to Admiral Markets. My name is Chris. Today's focus is strategy looking at Fibonacci and waves as part of a series that we've been going on now for 5 to 6 weeks, I think. So we have two sessions left within the Fib and waves. We're going to take a look today at more waves. Last week, on the 15th of February, we looked at a quick guide, about the rules and guidelines of the Elliott wave theory and how to practically use it. Today we're going to dive into more of that, but also from a practical point of view. First of all, though, be aware that this webinar is shown to a global audience. It may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, for wave analysis, of course, I recommend you to take a look at admiralmarkets.com, go to analytics and click on wave analysis among the other analysis that you find, such as technical and fundamental and articles and useful tools like heat map and sentiment and education. Wave analysis basically is taking a look, is conducted every morning and is posted every morning around between 6 and max 9 a.m. GMT typically, but more often than not around 6, 7 in the majority of the cases. And you'll find the 4 and 1 hour charts of the euro dollar, pound dollar, and dollar yen, and my take and most likely count of that particular day. That does not mean that you will see the most likely count. It doesn't mean that, in my opinion, that is a very high probable count. Sometimes it's very, very likely, in my opinion. Sometimes one count could be slightly better than the other, but I don't have the same confidence interval each and every day. But you always see the most likely version. To gauge a bit more about my sentiment, you can read what I am thinking about the chart below. So that's my number one tip, or first tip, I should say. Now, regarding where we left off last week, we really, at least I think that we compressed a lot of information there in one session. But I wanted to specifically focus on complex corrections today because I think that when you see five-wave patterns, when you see momentum, it is pretty straightforward, and we could expect an ABC correction after a five-wave. Those things I do not think require the same level of maybe scrutiny and are typically easier to handle than when looking at complex corrections and they also occur more often. Whereas if you look at the 80-20 rule, Pareto's theory that, typically you'll see an 80-20 balance. Those are just figures for comparison, for example's sakes. He didn't mean to say that it's always exactly 80-20, by the way. So I think that when using this rule, indeed, the market is maybe impulsive 20% of the time and corrective 80% of the time, right? As a rough indication. More corrections basically than we see impulse, and that's logical because price, when it moves impulsively, it moves quickly. If it were to move quickly all the time, then it would be a madhouse. Right? The market will be some roller coaster ride that we've never seen before. It already moves a lot with corrections. So if we would drop all corrections, it would be not tradable, in fact, really. So it's good we have corrections, and of course, sometimes corrections slow down too much, and then they're not so tradable. So it depends. But to have some corrections is good because it gives us market structure and it gives us patterns, and we could set up trades based on those. So most of the time also price is in a correction. As you can see here, when looking at this chart, we're looking at an upside movement. That's basically a correction. It's a part of a wave 2 correction. So although there was an uptrend, it was choppy, slow, and yeah, that's basically it, slow and choppy. So although it had an upside slant, overall we can see that it was not with momentum. Surely there were parts within this zone that had momentum on the lower time frame. So this could change as well as you go from lower to higher time frames. On an hourly or 50-minute chart, some of these upside pieces will have momentum and will move strongly. But if we zoom out, then we'll see that their overall structure is corrective. So that will depend if we, on what time frame we look at, whether that looks momentum or not. Definitely on a 5-minute chart, this 100 pips would have had a lot of momentum on a 5-minute chart, believe me, right? But on this time frame, we can see that those bits and pieces to the upside ultimately cause for a corrective piece. So let's talk a bit about complex corrections. Simple corrections are, for instance, A, B, C's, like this. That means that there could be a zigzag going on. A simple zigzag is where price shows momentum in the correction. So this, for instance, if we're in a downtrend and price moves up, a zigzag like that will have momentum. So does that have momentum? We do see momentum here in this leg, and we see momentum in this leg, right? So we see a bullish zigzag, in fact. So that's why I labeled it ABC green. Where the green is not so relevant, that's just a color code I use so you know on what level that ABC is occurring. You can use any color from my point of view. But the more important is that it's momentum in the A part, there's momentum in the C part. And if we put a fib from here to here, it will probably be about a 61.8 fib. The entire movement was about 250 pips. There was about 150 retracement. Yeah, I'm just rough balling it here. So that is about a 61.8 fib. Typical zigzags indeed do stop the 38, 50, or the 61.8 fib if you put a fib from top to bottom. So it matches what we would expect from a zigzag in both the momentum, what we see in leg A and C, and also the fib bounce that we see at the end of wave B. Okay? So that's why this is a typical ABC. It's a simple correction. It's one zigzag. But what happened is that price still kept going up and continuing higher. And it started to retrace a larger downside. There was a strong downtrend at that point before this turn. And this simple ABC zigzag was not the final correction. It still kept pushing higher, but it didn't invalidate the bearish downside. The top is somewhere around here at a 108, 109 or so, I think it was, right? So if price would have pushed above that, that would invalidate the bearish leg to the downside. But as long as price keeps slowly pushing up and not breaking that particular invalidation spot, which is the beginning or origin of the bearish move, then it could simply be a bullish correction. So just because there was one correction here, ABC, did not, or this ABC, actually, this is the first ABC, right? This is the second ABC. Just because those ABCs finished doesn't mean that the entire correction was over. That's when things get complex. The correction gets complex and gets expanded. So what happens then? Then we start to glue together these zigzags or other corrections. Of course, a zigzag is only one correction. You could have ABC flats where price is going sideways like this. Doesn't have to be exactly sideways, by the way. Let's say that where price is in the uptrend. Price makes a correction like this. It could be exactly sideways like this, and a new uptrend starts. But it could also be that the top gets broken by a bit, or the bottom gets broken by a bit. Those are different types of flat corrections. The max, there is a max though, we talked about that last week, that this particular correction can go above the top. So just go back to last week for that. But when we piece together all these corrections, triangles, flats, zigzags, that's when we use WXY to piece together these corrections, basically these simple corrections, and if we tie them together, they become complex corrections. So here, for instance, let's take a look at this. This is an ABC, and that's not it though. We have more corrections. So this is a W. This is an X, and here there is also an ABC within that X. And then there's the purple Y. Within purple Y, there is a blue XY. Why? Why is that? Because we have multiple zigzags here. We have a bullish zigzag, ABC green. We have a bearish correction within B, as you can see in ABC. There is an ABC for X and an ABC for blue Y. So we have multiple ABCs. So how do we piece together all those ABCs? By using WXY. Each ABC represents a W, right? ABC, W, ABC, X, ABC, W. And then that WX, in this case, that ties together three ABCs, is actually still part of one more larger WXY, which is purple WXY. So you have two layers of WXY. You have the purple one and the blue one. The blue one pieces together all those ABCs, right? And the purple one ties together three legs. This one, this one is two, and this one is the third. Within the third piece, we have three pieces as well, like this. And within those three pieces, we'll have all different types of ABCs. So that's what it does. It's basically connecting. Now, how do we know which one is happening at what point in time? So let's take a look at maybe a different chart. Let's take a look at, maybe we can take a look at the dollar yen, for instance. Now, knowing when a complex correction starts is in part a bit about measuring reactions to fibs, measuring the patterns and reactions to those decision zones. In some cases, there's never really a, let's say, 100% knowing about it. It's only the best guess, and then setting up invalidation and confirmation levels to know if you know a complex correction is occurring. So, for instance, excuse me, with the wave 1, 2, a simple ABC seems more likely because wave 2s in general, for instance, are typically known for being relatively short and fast, impulsive. So I think a simple ABC is typically sufficient for wave 2 to be completed. All right. Now, a wave 4 in general and a wave B correction are typically more longer and more corrective and complex. So when we estimate that a wave 4 or B or wave Y or wave X or wave W is occurring, those complex corrections seem more likely. In this case, I don't think there's going to be a very complex correction. I do think that there could be just a simple ABC down to complete wave 2 blue. That the ABC will have maybe an ABC within it, but all in all, nothing that fancy. However, with the wave 4, for instance, when here price finished the wave 3 and price made an ABC like this, there's a good chance that that is not enough, especially if price has at that point not reached a substantial fib or only reached maybe a shallow fib. When that happens, we could already kind of be on guard that the expansion can correct into a larger structure, as indeed is shown here, price making not only a blue WX, but also multiple corrections within that. So that simple ABC orange at the beginning right here was indeed not enough. And how do you know that at that time? Because of the fact that it is a wave 4 and because of the fact that typically a wave 4, there's a good chance for price to get down to the 38.2 fib. Price was not at a 38.2 fib when it finished the ABC orange. It's not conclusive, but these are good, solid probabilities that make it likely that a complex correction will occur, and were things that, if I remember correctly, were discussed and spoken about live as well. Now, let's take a look at the pound USD now. Alrighty. We can expect complex corrections as well if a complex correction is going on. It might seem simple, but for instance, if you recognize that price is moving sideways like this, look at the green and brown trend lines, right? And the red and blue. Just visually, you see the fact that price is in a corrective structure. Then typically that can last longer. When price basically bounced off the bottom, that was a wave X in my view. So that means automatically that we can expect a wave Y. So from that point of view, a wave Y itself could expand easily too. This gives basically, it's basically a matter of time for the market. It needs to go sideways at some point to catch its breath, to set up for a next move. If it were to be trending every single minute, every single day, there would be too much volatility. It cannot sustain that. So what it does is like a heartbeat. It moves quick, then slows down. Moves quick, slows down, right? So this particular movement is typical for, or is typical heartbeat of the market. So when we can see that price has made a correction and then another correction like this, then in this case, the wave Y green is not so strange that that could also end up being quite a wide and long structure, especially if you look at the daily and 4-hour chart. So having another ABC within that and perhaps another correction within the B is all part of the game, is all part of what we could expect. So in that case, it's important to look at fibs, trend lines, moving averages to understand when price might be able to move away from it and complete that correction, and when can it start new momentum. So for instance, here it bounced off the blue support line. All right, that could be one way of keeping an eye on whether price has completed a triangle or whether it still corrects lower, bounce or break spot, right? That's an important information about whether this is a bullish triangle or a bearish extension of this correction. So looking at a trend line like that will give us information on both sides. Looking at the fib will give us a clue about targets to the upside and to the downside. Looking at moving averages will show whether a breakout is interesting. If the moving averages are flat and on top of each other, the breakout is something that is more dangerous and has more risks. So you need to use practical tools, I think, for understanding when corrections are over and when momentum can start again and when corrections can expand even further. The guidelines for the Elliott wave theory will help you too. I did not go through all the guidelines, but if I would definitely recommend going through them. I don't want to go through all of them because I think there are many of them. First of all, I also think that it's a bit too theoretical. I think it's best if you go through them alone if you want to, and if you have any questions, to come back next week and ask me those. I think that's a better format. But there are many guidelines about, for instance, how the wave structure most likely will move, right? And if price doesn't break highs and lows, there's a good chance it will become a contracting triangle. So that is, again, an expanded correction that has 5 legs indicated by the purple A, B, C, D, E. We have the red circle. So that's basically one of the things you can look at. There are guidelines about so many things and aspects of the corrections, how the flats should behave, which fibs they should respect. We talked some about that last week. So let's take a look at we'll take a look at the live charts in just a second. I just wanted to show you one screenshot that I received from a trader about the odd yen monthly chart, and there was a question connected to that. Let's see. All right, now I was looking for the question, but if that person is in the webinar at the moment, I'm just going to look at this chart and give my feedback to you. If there's any follow-up questions, just feel free to use the chat. But basically, I think that this is a decent labeling. What I personally don't do is using WXY to finish an ABC, or sorry, to WXY to finish a green C. So what I always do is ABCs fit within WXYs, and WXYs not fitting within ABCs. That's just my way of doing it. Otherwise, I think it makes a lot of sense. You have an ABC here for pink B, you have a pink A, and there could be a pink C that could end at the bottom. Within that pink C, you can see the price is respecting the tops and bottoms, so move back to the bottom makes sense in my opinion. It is a corrective structure, complex correction on this monthly chart, the Australian dollar and Japanese yen. So that makes sense. Now price didn't reach the bottom as yet. So what could happen, I think, makes sense too, an ABC or a complex correction within that pink C. So an ABC there making sense as well. Personally, I think that with complex corrections like this, indeed there could be many ABCs, so there could be within the red B, there could be another ABC that makes a lot of sense. So there could be a continuation of those ABCs, and it could be an ABC like this, and an ABC like that, back down, and then maybe, again, continuation, who knows. It makes a lot of sense. I think that there's nothing wrong with this. There has been indeed a corrective impulse here. So we can take a look at the odd yen on my chart to see a bit better as I can move around on the chart. Now I don't do odd yen wave analysis. So it's really the first time I'm looking at it because I focus on the majors. But I'll do my best to do this live. Now we don't see more than 20 years ago. That's okay. And we do see indeed the flat here at this moment. We see that price has retraced up to an 88.6 fib here, even further than that. So this could easily be a flat. Oh. Sorry, trying to get rid of this fib. Okay. Okay, sorry about this. Having difficulty dragging those tools. So this could be easily a flat. Flat indeed means that we could see price back down to the 88.6 fib of this. So it should go back down. There's a good chance it will go down to basically the 88.6 fib of 60.65. Okay, just want to make sure I had it correctly there. So from that perspective, there's still space to the downside. We had a three wave like this, three wave like that. So it could be an ABC, ABC. Within a flat, sometimes the C leg has 5 legs, right? So from this perspective, this could be maybe 1, 2, 3, 4, 5, but we know also that this 3 looks pretty choppy. Let's take a look at that. It's difficult to see a clear wave 3 in this piece because there's so many strong retracements, and that is correct. That's quite corrective, actually. So that does not seem likely. It does not seem likely that this is a wave 3 and this is a wave 1. It does seem likely that this is a correction, actually. So therefore, a three-wave correction as a response to that does seem likely because of that. So because this is choppy and not impulsive, there's a good chance of a three-wave up rather than a wave 4 and 5 down. So that's one way of gauging that, how the correction can be more complex. If we look in this piece, you can see all right, there we go. You can see that this is probably an ABC zigzag. Then we had a correction. We can put fibs to see how far the retracements have gone. And price indeed going to the 38.2 fib. So this seems to be one leg. This seems to be another leg. And here seems to be another leg, like this. Now how you can measure legs is also by using the Awesome Oscillator. By looking at when it goes back to the zero line, you can measure that. And you can see that here it almost hit the zero line, but didn't quite yet. So let's take a look at the daily chart. And you can see that here it went back to the zero line. And here too. So basically what it shows is that this is one piece. Let me use a green a second. This is one piece, as you can see. So this is one piece. So you can connect the Awesome Oscillator with price action. This is a correction, so this is a correction. And this is one piece. This is one piece. So you can understand what swing highs, swing lows are one piece, and therefore know what to label, right? Because this is one piece that belongs to each other. That's one swing high, therefore that requires one labeling. This is one piece that we can label. This is a piece we can label. This is a piece we can label. This is a piece we can label. This and this and this. So when we look at those 7 pieces, then we understand that those are the main swings. So we can look at that and we could try to find 1, 2, 3, 4, 5 if we want to, but I don't think it's possible within that structure because this is no way a wave 3 and this is no way a wave 4. It's too choppy and it goes back into wave 1. So it's a corrective structure. All right? From that perspective, this finished one wave 2 because if you look at the weekly, you see that this finished one spot and this finished one spot and this finished one spot. So we can put a leg on the entire correction here like this and look for how price responds to these fibs, the 50, the 61, the 78.6 fib. When looking at the daily chart, we can try to measure on the lower time frame whether we see a 5 wave up here, for instance. That could indicate that we might be in an ABC zigzag on the lower time frame, or we could be in a wave 1, 2, 3, 4, 5 within the A, for instance. Looking at lower and higher time frames will help us measuring that. Now, at this moment, I think probably still likely that it's an ABC, but we can do a fib like this to here. And if price stays around the minus 61.8 target, max 1,000, it is probably an ABC. So at this moment, I think it's more likely it's an ABC. One thing that shouldn't happen is price should not go back into the territory of wave 1. So if it gets below this green line, it will probably be ready for a breakout to the downside. And there is a bit of divergence between the tops plus the 50 fib and the potential for an ABC to be finished. That could be a bouncing spot on the odd yen and could be an interesting short potential there at the 50 fib. All right, there are bottoms in here too. And in that case, there could be basically a correction like this and move down again. Now this correction could be expanded. And how do we know that? If price then starts to drop from the 50 fib like this and has trouble breaking these support levels, we can put a fib on the opposite side. From here to here. When price hits the 50 fib, then turns around and then shows struggle at the 50, 61, or 78.6 fib and shows bullish bounce potential there with candlestick patterns, for instance. Then, in that case, what could happen is that it could expand up to the minus 272 target before moving down, back down like this. All right, so that's how a correction could expand. But we don't know that for sure. This could be all of it. This could be a simple ABC and it moves down again. But if price does show potential bounce potential through strong candlestick patterns at these fibs, then that could indeed turn into a complex correction. And it could expand into a bigger three-wave that brings price back to a higher fib and a fib target, and then it could turn back down and retest the bottom. Which one of these two is more likely is, for me, not relevant at this moment. I think they're both likely. It all depends on whether price bounces at the 50 fib, whether it moves down as I expect, and how it responds to these fibs, if it breaks or bounces. If it breaks, then we can continue like this. So sometimes there needs to be a waiting period to see how price does respond to key support or resistance levels. How do patterns, what kind of patterns emerge there, time patterns, how chart patterns, candlestick patterns emerge at those key support or resistance levels to get an idea whether there's going to be a bearish trend or a bullish bounce, what kind of wave patterns might fit with that. Now, that is, I think, about it, what I have to say about this odd yen at the moment. Maybe we can take a look at an example from the past. For instance, here we had a correction back down to the bottom and price moved back up like this. Now, I'm not 100% sure, but this does look like a 5-wave, in fact. So, when price goes sideways like that, we could imagine that there could be an expansion of that correction through an ABC like this. But you can see how long on the monthly and weekly chart, of course, this red zone lasts. But that just gives you an idea that indeed the correction could be continue if this is 5 waves finishing, for instance, A, and then we have an ABC like this, for instance, right? So that could be the end of B, potentially. But then price stalls here, and it doesn't really break the top with a lot of good momentum. And we see a bull flag like that, pretty corrective, and then a break to the bottom. In that case, there's a good, when the bull flag breaks to the bottom instead of to the top, above the resistance, there's a good chance that this is not an ABC correction that will finish the entire correction, and there's a good chance that there will be a complex correction, right? So measuring how price responds to this top, to this bull flag, and the failure to break with momentum, the failure to continue and break the bull flag, but rather break the bottom, indicates that a larger correction, not only this, but even this, and then this, will occur. So that's why I always take a look at key support and resistance levels to get a better idea about that. And indeed, the correction not only ended up like this, but way more complex, as you can see. The measurement of continuation really was how price responded as it broke at this point. That's when we had the full continuation push finally. We had an attempt here, but ultimately the candles here running out of steam. 2-3 candles like that is not a good signal for a bullish breakout. As you can see here, we never had such a thing. Then 5 to 6 candles not breaking this high, indicating that around here, indicating that this particular swing high, swing low is over, and that bullish push has been completed. Now, another thing you can do to measure whether the complex correction is over is measure the initial move like this, 78 days. The complex correction is often larger than that. So this initial 3-wave like this, for instance, was only 47 days. That's shorter than the original upside move that had some momentum in it, actually. So typically, it's at least as big, if not 1.5 times as big. So if this is 78 days, then the complex correction could easily be 1.5 times that, or even double that. So between 120 and 160 as a rule of thumb, and it ended up at the upside started here at 130. So looking at time factor like this is another tool. All of them you got to piece together to have a good idea. But piece by piece, we can make a study like this. So this push was not bad as well. This push started around 90, but we know that that was a bit on the early side, right? 120, 160 was the ideal zone. So this push early, and then ran into 3 candles like that, candlestick pattern indicating that there is not enough steam and there could be, again, one more extension of that complex correction. So this is how you can measure basically complex corrections. What phase of the structure are we at? What is the higher time frame saying? What are lower time frames saying, and what kind of wave patterns do we see there? Where the support and resistance and decision zones, fibs, trend lines, invalidation, confirmation spots, time analysis, looking at patterns, candlestick patterns, chart patterns, time patterns. Not only time patterns like I measured here, but also time patterns in the sense that how I use it, 5 to 6 candles not breaking a high and indicating that could be the end of this momentum. Looking at the oscillator for swings, and understanding that sometimes certain corrections get expanded depending on the wave structure as well. I think that's about it. Any other questions at this point? For more webinars, by the way, Nana just takes a look at a live trading session that is 1:45 p.m. GMT time. And tomorrow we take a look, by the way, at pivot points Thursday evening. So I hope to see you in there. Of course, you can check out our recent article about time factor if you want to know more about that, and fractals. There was a recent article, and you can check that out if you want, or the MetaTrader 4 Supreme Edition, of course, as well. All good things to discover. Great, Ibrahim. I'm happy about that. If you or anyone else still has a follow-up question, of course, you can feel free to write Animal Markets or myself if you have my email, and I'll get back to you as soon as I can. I'm a bit running behind emails at this moment because a lot of things, I'm looking at a lot of different things, including time factor, strategy that I'm developing, and some other things, but I will try to get to them by the end of the week. And thanks for being here and joining this wave. Next week we have one more wave and fib webinar. Looking forward to that. and wish you all good trading. Cheers.